In this video, we're going to look at a common trading bad habit, averaging down, what it is, and how we can take steps to eliminate it. Hello, I'm David Jones from Capital.com, and this is one of a series of videos that we're doing where we're looking at trading biases or trading bad habits. Our trading platform has an algorithm that will look at client behavior, and if it detects that maybe they're slipping into bad habits, we'll try and push them in a different direction to make them aware of the biases that they're developing. This time around, we're looking at the idea of averaging down. So first of all, what do I actually mean by this? Let's take a look. So let's explore this trading bias of averaging down. Let's go through an example. Let's stick with shares for now to keep it simple. Let's say you buy 1,000 shares in a company at $50 because you're expecting the price, of course, to go up. But you're wrong. The price falls to $40. So what you do now, you buy an additional 1,000 shares at $40. This is averaging down, not that I am recommending it as an approach. Your average price is now $45. So you bought 1,000 at 50, you bought another 1,000 at 40. So your average price, because you bought the same amount, is the average of those two numbers, which is $45. So why does this appeal to people? Well, if you have a conviction in your trading, investing view on that particular market, whether it's a share, a currency, or a commodity, as we saw in the previous example, it does end up giving you a lower break-even point. Assuming you're right on the ultimate direction, and if we go back to that previous example, assuming the price does recover, you're going to make more profit on your holding because you've bought more and you've ended up with a lower average price. However, in reality, it's often a sign that someone cannot admit when they're wrong and take that first manageable loss. They've got an aversion to losses and may just be gambling. So they bought in at 50 because they thought 50 was a good price. Rather than maybe having a stop loss, they bought some more. They averaged down. One way of comparing this is the martingale approach in gambling. We talked about gambling here, where people will double bets after a loss and continue doubling their stake, hoping they're going to cover that initial loss. So in a nutshell, it's adding to a losing position as the market moves against you. That's the theory. Let's take a look at an extreme example in the real world. Let's take a look at the risks of averaging down. I've got a US stock, General Electric here. Let's go to the right-hand side of the chart, May 2017. The price is just below $28. You decide to buy in. So let's say you buy some shares at $28. You buy 100 shares, so that's $2,800 invested. Let's jump forwards a few months. It's now July 2017. The share price has slid. It's now trading around $25.50. You still have the conviction, so you decide to buy another 100 shares at $25.50. This does bring your average down, but you're adding to a losing position. Let's jump forwards a few months again. It's now October. The price has slid further. So you bought initially at 28. They're now trading just above 23. You decide to average down again. And a few months later, the price is now trading at $18. So you need, if you want to average down, you need to have more money again. And you're adding to this losing position. Just look how far they've slid from that $28 mark. It would have been much less painful to have had a stop loss when the trade was opened and come out for a manageable loss rather than adding to the losing position. And just to bring it up to the present day, at the time of recording, the price was trading at $12. So it's more than halved from where you bought that initial bunch of shares at $28. So this is an extreme example, but it does show you the danger of adding to a loser. You're compounding your losses if the market continues to slide, and you're tying up money that could be used probably much better somewhere else. So that was an extreme example, but you can see the risks. If the market continues to go against you, you're just throwing good money after bad and tying money up. So let's now take a look at the steps we can take to make sure we don't get into this bad habit. So we've identified why averaging down is a problem for some traders, because it means they're trying to avoid taking losses, and taking small manageable losses is all part of trading. So when trading, have a definite stop loss level. If we're buying at $50 in that example, and we decide, well, at 47, if it falls to there, I'm wrong, have the stop loss level there. If the market gets there, take the loss. Don't add to losing trades. If you've bought in and the market's sliding and you're continually adding, you're clearly adding to your losing position. And if you want to carry on averaging down, you may need an enormous amount of money if the market continues to slide. So it's often a good rule not to add to a losing trade. Don't dig yourself deeper in the hole. Averaging up, however, is different. If the market starts moving in your favor, there's nothing wrong to having an approach and a plan to add into your position. The market has started going the right way. The initial trade is winning, so you can always think about averaging in that way. So it's a cliche in trading, but very often the first loss is the best loss. Averaging down is really just compounding that loss. So it's something as traders that we really do want to try and avoid. I hope you found this video useful. There'll be a whole load more content that we'll be doing on this topic. So to never miss out, just make sure you're subscribed to the channel by pressing subscribe. And if you click on the notification icon, you get automatically notified every time we upload a new video.